Hello, today we're going to talk about cash flow. So this is what the first part of a cash flow forecasting table might look like. So you've got your weeks running along the top, and then in the very top section you've got your inflows. So for a business these would be things like revenue coming in, and all your inflows are added together to get a total. Following that you've got your outflows. So for business these would be things like expenditure on raw materials or paying staff wages. And again, all of these outflows are added together to get total outflows. So you should be quite familiar with that side of things. The final part of the table is a bit new to you. So firstly, we've got another line for the opening balance, and I've put that one cell in pink because that week one opening balance, the starting point, is something that you're always going to find in a case study or always going to be given, so you need to look out for that. Then we've got a line for net cash flow, and again this will be new to you, and this is simply the difference between your total inflows and your total outflows for that particular time period. And then finally we've got closing balance, and this is just using the two rows above, so it's looking at opening balance and then applying the net cash flow to come up with a closing balance. So that's what our little performer is going to look like, and we'll just go on to do an example of a personal cash flow from the point of view of a teenager. So we've got our weeks running across the top, and now we're going to start thinking about some of the inflows. So perhaps you get £10 a week when you're at college, dinner money from your parents, maybe a bit on the low side, but keeping the figures nice and straightforward. Perhaps you also get an allowance from your parents for things like stationery or things that you need for college, or personal items that you need. And again, that might regularly go into your bank account. Sometimes, although not in the period of the 3 weeks that I've shown on here, you might get quite a big inflow of cash. You might have your birthday, or maybe it's Christmas, and all of a sudden you get given £50 from your nan, and etc., and you get a nice big lump sum coming in. But obviously during this period, nothing coming in for birthday money. So then you can add together these inflows, and you can see that in week 1, week 2 and week 3, the inflows have been pretty steady, and £20 a week, and that's relatively typical for households. So after we've worked out our inflows, we have a look at the outflows. So in this example, I've assumed that actually this teenager does spend some of their dinner money on actual food at college, but a little bit less than the money that they're given from the parents. And you can see here the figures are in brackets because these are outflows. This is money going out of the business, so it's treated as a negative number in cash flow tables using brackets rather than a minus sign. Also, we can see the students being quite conscientious, and at the beginning of at week 1, at the beginning of our forecast period, they've bought some stationery, maybe some pens and a notebook, etc. But in week 2 and 3, they haven't spent any more on that type of thing. And then we've got phone expenditure. So here, we're looking at somebody that maybe tops up their credit every few weeks rather than somebody that's on a regular contract. So here we can see week 2, there's been some expenditure on phone credits. And then finally, more expenditure, another thing that doesn't happen every week, but friend's birthday, £10 spent on card and present for the friend. So again, we can add these up and we get our outflows. And you can see that these are a little bit more variable. So, on week 1, £12 outflow, which is quite nice because it's actually less than the inflow coming in. Week 2, though, we've got a bit of a heavier flow of money going out, and this is actually exceeding the inflow in that week. So now we'll carry on to complete the rest of the calculations. So our opening balance, we'll assume that this teenager is actually quite good with money, and they've got a little nationwide account, and everything they pay they use their phone and they do pay as you go. Parents put the money in automatically, so there's that one place, and they always keep a balance of £50 in that account, just in case they need to get a taxi home or something, or in case their phone runs out of credit. They know that they've got enough money in their account, they can just top up straight away. And then we now calculate the net cash flows, and then finally the closing balance. And I'll come on to net cash flows now. So net cash flows, so this figure here, this £8 we've got here, is simply the total inflows minus the total outflows. So it's this £20 here, take away that £12, gives us £8. So we can see here that our inflows have been bigger than our outflows in week 1. The next step then is to then take that £8 we've just calculated, and in this case they're both positive, so we're going to add it to our opening balance, so we come up with a total of £58 as our closing balance. So at the end of the week 1, in terms of cash that this teenager has in the bank, they've now got £58. And that £58 becomes the opening balance for the next week. So week 2, they start with £58. And similarly, the next period, week 3, starts with 51, which is the closing balance from week 2. So you can see that this just keeps rolling along week after week. Okay, so that's quite a simple example, and if looking at this, we can see actually the bottom line, the closing balance all the way through, is in the black, so that is a good thing. This teenager is managing their money quite well, and they've always got enough money to pay the things that they need to pay. So although they've got that heavy week in week 2, where their net cash flow was -7, they were able to pay that because they've got a bit of a buffer in that opening balance, so that didn't really affect them too much. So we'll just go on and have a look at another little scenario. So now, keep the format of the table the same, and everything else in the table has stayed the same actually, apart from our opening balance in pink. So on the previous example, the opening balance, their starting point was £50, and they always like to try and keep that minimum in their account. Now we're going to have a look at an opening balance of 0, and nothing else has changed, so we're just going to scroll through the figures and see what happens with that knock-on effect. So all the other figures are this, in terms of the inflows and outflows, are the same. All that will have changed is that those lines at the bottom, because of the working through with that opening balance. So you now see that actually by the end of the week 1, they've got a closing balance of 8. That is carried forward into week 2, and it's only just more than their outflows. So that leaves them with a closing balance of 1 at the end of that week, and that's carried forward into week 3. And again, things start to get a bit more healthy in week 3, because here their inflows are significantly higher than their outflows again. So, that's all right, it's pretty close. Week 1, maybe they've had to think a little bit about what they're spending on food. Maybe they've had to put a limit on the amount of money that they spent on their friend's birthday present, but that's still quite a manageable sort of cash flow. So keeping the closing balance as 0, opening balance as 0 again, this example, we'll now move forward and see what happens if actually they've got a little bit more expenditure that they need to do in week 2. So as I say, this is the same as the previous example. Now here, the difference is they're spending a little bit of money on stationery and books in week 2. And what has happened now is that has had a knock-on effect on the closing balance. So week 2, they've got an opening balance of £8, but now their net cash flow is bigger than that opening balance, which means their closing balance would be negative. And then when we go into week 3, that negative closing balance is carried forward. And by the end of week 3, they've had more money coming in again, and they're back in the black in terms of cash flow. So you might look at that and think, oh, that's all right, actually. They need a couple of extra quid. Maybe they'll just borrow that off their mum or something and they'll be fine. And that, for a teenager in practical purposes, that is fine. From a business point of view, if you were looking at a figure like this, you'd be a little bit concerned, because this is saying, if you're doing this forecast, actually when it gets to this point, the business is in a state like Thomas Cook, where it's coming up to the end of the month and it's not going to be able to pay those final few bills. So from a cash flow forecasting point of view, this -3 figure on week 2 is a concern, and this is why businesses run scenarios, so that they can see where they're likely to get into this sort of situation, and they can put things in place. For example, put an overdraft in place so that they can get the cash coming in that would cover that type of scenario, because a business cannot continue to operate when it doesn't have any cash. Thank you.